everybody. My name is Julianne Peterson, and I am your host tonight for Zoom at 8, as well as a senior director at Old Capital Lending. And we have been doing Zoom at 8 for over 3 years. We've closed 12 deals. In fact, we have a person that's just closed the 12th deal in the house tonight. So I'm super excited that Gary's here. We're going to hear from Gary in just a minute. But Old Capital, as you may know, we are a large multifamily provider of debt. And you know what? It is a tough time to be in the debt business. Challenging, no doubt. We've got deals that are, changing and moving and canceling. So you are in good hands. Old Capital's been around for a very long time, 36 years, doing what we do best, which is close loans. We've closed 6,500 loans. So, we're talking about execution certainty. And many of you have come into this multifamily arena in the last couple years. And maybe you haven't closed anything yet, but it's taken you 2 years maybe to build your team, to find a deal. And when the rubber hits the road, you want to be working with a team, and I'm part of your team that will help you close that deal. Because when you've got hard money, you don't want to lose it. And that's what's happening in today's market. People are losing enormous amounts of money. So don't be trying to do something creative. Everything needs to be underwritten very, very closely. So Gary Van Bortel is in the house. You guys, if you don't know Gary, I've closed 2 loans with Gary over the last couple of years. Gary, how are you tonight?
Hi, Julie. I'm doing fantastic. And absolutely everything she said is 100% true. Julie has worked with my partner and I on 2 deals we've closed. And we just closed 20 days ago here, a couple weeks ago, rather, on our latest acquisition. And everything went terrific. Julie is very instrumental in making sure those things happen. So we did not lose our money, and we ended up with very good financing.
Gary is the guy who I told everybody, if you weren't here previous nights, we closed a deal with Gary at 81% leverage on an agency loan. How lucky is that? Gary, can you be so proud to know that you are the only one in Old Capital over the last year that has closed that high of leverage? I mean, really a great asset. So can you give everybody kind of a little overview of the asset, why you like it, what your plan is, and maybe in a year come back and we can hear the success story?
Yeah, sure, absolutely, love to. So it's a 37 unit. I'm in upstate New York. This acquisition was in Syracuse, which is about an hour and a half from where I live and 2.5 miles from the property my partner and I previously syndicated in 2020. So things we liked about the deal was that it was close to our other property. It's in a great area that it's a Class C or value add property, kind of run by a mom and pop operation. The guy really just did not, increase or improve the property much at all. Left a lot for us to do, increasing rents. We instantly could see that we could, increase rents by at least $100, just leaving it the way it was. But our plan is to go in, we renovate the units and increase the rents. So it's a syndication play. We have investors on our deals, and we work hard to raise the capital. My partner and I put down the earnest money and do all the due diligence. And we've worked with Julie on getting us agency debt financing. And as she said, it was 81% LTV because it cash flows. So we're very happy with the numbers. And, I got to say it was a little challenging just because of the way the economy's been going. But we made it through. It is a lot of work to get these things closed. Our seller was not one of the best ones as far as making sure that all the rents were put in the bank in a timely fashion. So rent collections were all over the place, but we managed to convince them that we were going to do a good job and turn the building around. And we started doing apartment renovations on it just this past week. So we've got contractors that are been working with us on renovating units, and they just started on this new property here just this past week.
That's so fantastic. Gary, there are things that happen when you take over a property that you go, that guy didn't tell me. That guy has money that's sitting in an envelope. Did you find anything that was a surprise that you didn't expect? One thing, do you have anything you could share on that?
There's a few things, yes. One of the things that just, you got to come up with a checklist on everything that you need to do. We were so busy, I completely neglected of thinking about the utilities, right? The gas and electric and the water bills. And it was like 2 days before close, and I'm like, oh my gosh, I never called the water company. I called them up, and they are like, we need your attorney's phone number. And I said, and we were ready to close. I mean, all the numbers were drafted. The attorneys were, just calculating the interest down to the final day. And I said, why do you need my attorney's number? And they said, well, we'll tell you because there's an outstanding debt of $6,000. $2,000 has been put on the tax bill already, and $4,000, and we were about ready to close. And I'm so grateful I made that phone call, but that was a surprise. But it turned out well, because during close we said we need this money so we can pay the debt that's already been applied to the tax bill, and there was a 40, it was all together a little over $6,000. So
wow,
yeah, you just there's so many things you got to think about, and going on with that. But yeah, that was kind of it ended up well, but kind of one of those few things that you got to be thinking of so many things, not only, raising money from your investors, getting to close, and, just making sure everything is, is set to go.
absolutely. Well, that is great. I love that story. Mr. Ryan Ketchum, we closed a deal with them, and the same thing happened, although the owner turned off all of the utilities, and you might have heard the story, but Ryan got stuck. He's in the house tonight. He got stuck with his property manager walking out on the day that they took over. His property manager was the previous owner, was going to manage it for him, and he quit on the day that they took over and had utilities shut off. So you know what? It's not all fun and games, but you need to be prepared, and hearing people's stories like Gary is so helpful. So Gary, thanks a lot for sharing that. That is helpful for everyone in the house.
Absolutely. Yep. It's a lot of fun, and we are digging our heels in, and what's exciting is that the first property was the same type of thing. The tenants, we wanted to improve the tenant base. It needed to be done, and we wanted to improve the units, which we've done significantly. It's been 2 years. I went back to the property, and we're there all the time, but we had an inspection. It's kind of a regular thing with the agency debt. I had to go through 10 units that we had already remodeled, and I was just so proud. They look so nice. We have gleaming hardwood floors that we've spent a lot of time refinishing. It's it's an older building, and we've just made it really nice. And now I look at this new building, and I'm not so, I'm like, I know we can do it. It's going to take a little while. We've got, the tenant base needs to be improved. And, the building has, some woes, some, neglected maintenance. But, knowing what we've already done, it just gives you the confidence and the ambition just to move forward. And, we know we can get it done.
Well, and that is, I've sat in on some education programs, and they say, well, what do you want to see? What is your drive? And my drive is to improve communities and see the hard work that you put into a property, and see how people will live in your property. How do they make a home, your unit a home? So it is great, and I appreciate it. Well, listen, everybody's back. Jay Parsons is here. You guys didn't come to work with me and talk to me, but I'm so glad everybody's here. But really, the star of the show is Jay Parsons with RealPage. And we'll let Jay talk a little bit more about RealPage, but he does a lot of information on data analytics and looking at details and how does that information translate into our world in multifamily, in some of the other asset classes, the commercial asset classes. So just a little bit about Jay, and then we're going to turn it over to Jay and ask some great questions. So Jay Parsons serves as VP, Head of Economics and Industry Principles for RealPage. He is a frequent author and speaker on topics including rental housing investment and asset management strategy, rental housing policy issues, risk management, and property management, covering apartments and single-family rentals. Jay has been cited in the Wall Street Journal, Bloomberg, Financial Times, and CNBC, among other outlets. His commentaries have been published by the Penson Real Estate Association, the Mortgage Bankers Association, the National Apartment Association, and American Banker and Globe Street. So we have the Wizard of Oz and data information along here with us tonight. And I want to welcome you, Jay Parsons. Thank you for jumping on. I appreciate you being here tonight. And everybody, if you would give your attention to Mr. Parsons, go up to the right side of your screen and give us the speaker view. And then we get to see Jay and all of his beauty. Jay, good evening tonight. How are you?
I'm doing great. Thanks so much for having me, and excited for the discussion today.
Yeah, it is great. Jay, where are you located with your 4 children? Right? No, you have 5 children.
5, yes, 5 kids, and we are in just outside of Dallas. So
outside of Dallas,
nice
okay.
and hot.
Yeah, nice and hot. And boy, how long have you been in Dallas?
You know, I moved to, I'm an East Coaster originally, moved to Dallas in 2005 and married a Texas girl. So I'm here for good now.
You're not leaving. You're stuck there.
No,
well, you have seen a lot of growth over those years, right? And so you can speak to it, being that Texas is just the place to be. You're seeing this firsthand, a lot of this stuff that we're going to talk about tonight. So, you know, our audience is, it ranges. We've got new investors, both passive, and we've got general partners. We have sponsors. We have vendors in the house. We have capital raisers. So a lot of people here learning, trying to understand. We've closed 12 deals within this community. It's a very, a lot of people come to Zoom at 8 to learn and to network. So tonight, I really want to offer our audience and, you know, the people that are listening after on the YouTube channel, you know, what is going on? We're June 28th. We're the end of the first or second quarter. What is going on? I mean, if anybody here had just woke up and you fell out of a tree or something, or you've been living under a rock in the last 2 months, 3 months, 90 days, a lot has changed. And, you know, I want to hear from you. What are the trends? What do we see from location to location, from east side, north side of Dallas, looking at different markets, Class A versus Class B and C, value add? I mean, we've got a lot to talk about tonight. So let's start out with, where do you see the market today?
Well, that's a great question. So it's obviously changing fast. But I think so far the impact of rising rates and inflation is we're seeing more on the mortgage origination side for single family loans than it is on the rental demand side. In fact, you know, typically for the last 10 years, I've been telling people, hey, look, I mean, these are different demand pools. They don't compete as much as you think. But now that, you know, rates are going up as much as they are, the cost of homeownership has gone up. Obviously, that's pushing more people into the rental pool. So we're still seeing a lot of demand for rentals, both traditional rental demand, as well as now some additional, you know, spillover demand. And then, you know, because of that, you know, we still have a lot more demand than we have supply of housing. We have undersupply in all types of housing. And that's driving up rents. And I think we're still going to see, a lot of prognosticators were forecasting a big drop off in rent growth this year. We would never did. And one reason is just, we're in an inflationary environment where there's a lot more demand than supply. So I think we're going to see continued rent growth for quite a while.
Quite a while. Is that 10 days? Is that 2 weeks? Is that 2 years? What does your crystal ball say?
Well, the crystal ball is a little fuzzy, but if you go back
Yeah.
to the 1970s and early 80s, that was the last time we had inflation like this 40 years ago. And back then we saw rent growth, in the 7, 8, 9% range. And then after inflation went down, we saw the last 40 years where, it was a very stable inflationary environment where it's, CPI, we all got used to kind of cost of living adjustments in the 2 to 3% range. And everybody who does underwriting got used to just putting 3 to 4% and kind of smacking it in there and being happy with it. So I think as we go forward, we are anticipating still a lot of rent growth, we're at around 15% right now for new leases, about 10% for renewals, and we're forecasting we remain around 10% for new leases for 2022, and still elevate in the high single digits for next year. So, the one good I should say one tailwind here is that incomes continue to grow. And we're seeing that particularly in the apartment market, where the demographic that rents apartments, market rate apartments, has fared very well economically. We've seen dramatic income growth among new renters who are signing leases, and that's helping support the higher rent growth. And we've seen people continue to pay rent. One of the great myths through COVID in the last couple of years, and people can't afford to pay rent. Well, guess what? 95% of them are paying the rent, and they continue to pay the rent. And so that's a great tailwind. But, the big risk here is that if wage growth goes away and you get to that kind of dreaded stagflation scenario where all your other costs go up, your food and your gas, but your income doesn't grow anymore, that changes everything. So I'm hoping that isn't the case. I'm a glass half full guy, but that's certainly a scenario to be watchful for.
And when would we see that? I mean, if we're being told we're going to be going into a recession, right? Some people say we're already in a recession, right? We've already seen first below CPI, right? When would we be able to note that? I mean, I think a lot of us are underwriting to some of these rent growths, 2, 3, percent going forward. But could we say in the first year, 7, 8%, bring it down to 6, 5% in the second year? I mean, what are your thoughts on underwriting the rent growth and knowing that wage growth may be right around the corner?
Yeah, no, that's a good question. I think that a couple of things there. I think, first of all, I think the economy is a little more resilient than people give it credit for. I think that's been true since 2010. For those of you who've been around a little bit, it's that uncertainty has been really lingering since the great financial crisis. It's like no one ever really wants to admit, kind of the headlines, the policymakers, there's been this kind of lingering uncertainty for the last 12 years. And I think because of the scars of the great financial crisis. And so as you look at kind of where we are right now, we definitely have some very real challenges. I mean, inflation is a big concern. It impacts our residents. It impacts the operational costs, payroll, utilities, insurance, property taxes. These are all real challenges. Right. I think that when it comes to the underwriting side, you have to kind of pick a side. Like I think you can make a scenario in which there's going to be a recession. You want to be very conservative in that scenario, and I think it's a plausible one. But I think you could also create a scenario where rent growth remains fairly robust. And again, if you look back at the late 70s and early 80s, look at the data we do have available at that point, which is primarily census data, we see that rents did grow through that period, which included multiple short recessions in that inflationary period. And so I don't think that rent growth is necessarily the challenge. I think the the bigger thing to watch is going to be just the household formation and how much demand we can continue to see amidst, the as the market gets more and more challenging and costs continue to go up, not just for rent, but for everything.
Yeah, I mean, everything is just out of control. Just to go on a plane, for heaven's sakes, is $600 to go, to the next state. So it is crazy.
A loaf of bread is $6 these days. I mean, that's crazy. I'm not even that. I don't feel like I'm that old. Maybe I am, but like $6 bread is crazy to me.
And will it go down? I mean, seriously, is this going to change once this recession is over? What can we expect? Again, going back to, if we are in a recession, will we see the rent numbers go down? You talk about family formation. Are we going to have 4 people renting? They're all working out of the same house. It really can't. Is that realistic?
Well, yeah, I mean, rents are dynamic. I think that's one thing that's different from, other things, is that rents are responsive to the market. And so we saw, particularly in coastal cities like San Francisco, New York, we saw dramatic rent cuts back in 2020 at the heart of COVID. We did not see that elsewhere. And so if we do get to a real stumbling point where there's an actual recession, demand goes away, we could see rent cuts, absolutely. But I still think that's probably going to be more isolated, or I should say, I think that's, at this point, it's plausible, but it's not our base scenario. I think the big thing to consider is that unemployment is still so low, and that we're starting from a point in this challenge where you still have employers with more job openings than there are job seekers. Now we're seeing a little bit of noise in the tech sector. That's a little bit of a challenge, but what I'm rooting for and hoping for is that those challenges in the tech sector do not bleed over to the rest of the economy. Now, if that happens, of course, then that changes the scenario here. But my baseline expectation is that because of the shortage of workers in most of these sectors, it's going to help kind of buttress the overall job market, which helps continue to drive wages up to keep pace with inflation.
So let's talk about the trends in COVID. As you mentioned, we saw from the coast, New York and San Francisco, for sure. We saw a lot of people migrating out of those to either, the mountains or the suburbs. There was some thought of, well, those are the millennials that are they're going to go and have families. We're going to start to see, a lot of people not really returning to the cities. So are they going to get back to the cities? Is this new generation who are graduating over the next couple of years, are they going to get back into the cities and that's going to grow and develop? Or is this truly a big change and a pivotal change for all of us, that it's no longer going to be the cities? You're going to go into the cities and you're going to leave the cities. And I ask that because there's a lot of people here that are looking in tertiary markets. And so that's really going to affect, is this trend going to continue? And is this a viable option to go to these tertiary markets? Because in the past, they've gone there and they've left. And now you're stuck with this building. So what are your thoughts on that?
Well, no, I love that topic. And I'll tell you, I think let's go back a couple of years to COVID, everything you described that happened, there was people left the cities. I think the numbers of which are probably exaggerated a little bit in the headlines, but obviously we saw a vacancy spike in the big coastal cities and drove demand to the suburbs and the tertiary markets, particularly in these destination markets you mentioned, the mountain towns, the beach towns, et cetera. Now, a couple of years later, you look back at what happened over the last, really since the start of 2021, we started to see demand come back to the big cities, particularly places like New York and Boston, DC, LA to some degree, Seattle. San Francisco is a little bit different. I'll come back to that one, but still saw some returning demand. And what was interesting, though, is that it didn't come at the expense of these tertiary markets and of the Sun Belt. And so here's what I think happened. I think that COVID accelerated some moves that were going to happen anyway in the next couple of years. I mean, you move to Manhattan. I hate anecdotes that drive stories because they're sometimes misleading, but I'm going to share one. Like, I have a brother who's living in Manhattan with his wife. They had a kid. They were planning to move back to the South at some point. Her family's from Florida. And so COVID just really made that decision happen 2 years earlier than they otherwise would have planned. Now they're not going back to New York.
Okay.
And I think there were some situations like that. I mean, those big cities, you have people who live there for a stage of life and then they move out. I think what really changed, though, it's not that everybody boomeranged back. The people who wanted to be there, they stayed, or they just moved temporarily, they came back. I think the bigger factor was that in 2021, particularly once the vaccines are widely available, and that was the key in the vaccines and the return of the kind of nightlife scene going out, not the return to the office. People didn't want to do that. It was everything else. The cities reopening. We saw that inbound train of young adults who wanted to live in the city come back. And so it's kind of this best case scenario where the cities have seen rebounding demand in most of these places, but it has not come at the effect and impact of the tertiary markets. And so we're seeing just tremendous demand in, places like Wilmington, North Carolina, and Naples, Florida, the Space Coast in Florida, Savannah, Georgia, some of the small places in the obviously we talked about the Boise's, but also the Provos, Northwest Arkansas, Asheville's. I mean, all these smaller towns, and I just named a few, a lot more we could name, that became attractive. And I think the real game changer that in hindsight, obviously, is the work from anywhere factor. I mean, people can work from anywhere more often than ever, and they're choosing to live in, not everybody, but enough people to move the needle in these smaller towns. So I think that has a lasting impact, particularly if you're in a tertiary market. It's not just a tourist town, but is an attractive place to live. That's got some good lifestyle anchors. I'd be very bullish on those spots. And frankly, I think they've really changed in the sense that you have more investors than ever who are targeting those markets, even to the institutional level, which means that they're more liquid than ever. So I think that that's a long answer, basically a way of saying, I think it's here to stay in the right tertiary markets.
So with that, going to these cities, working out of the house, that has changed because you can't have 3 roommates. You got to get rid of one because you need their room, right, to work in the office. First of all, is that going to stay? Is it going to stay where people are going to continue to work out of their house? You don't see that trend changing so much. And then with the new developments, are you seeing this? You're going to have the apartments with a den or with an office. Have we seen a change? Have we seen this being absorbed into, hey, this is the new lifestyle? And even so on single family homes, how is that changing as well?
Yeah, so the on the households, I mean, the roommate situation in COVID, after COVID, really starting in the summer of 2020, we saw a lot of decoupling of roommates who, because they wanted to have their own place to work, they got tired of being with each other through the lockdowns, and they needed a little more space. And so one of the things we're able to track through RealPage is things like household sizes of number of lease signers. And we did see that go down through COVID. It hasn't really increased yet, but I do expect it to increase, particularly as rents get more expensive. Again, I'm generally bullish on affordability, but I think, just being realistic, I think as rents continue to get more expensive, I think more people are going to look at, doubling up again. The fact there was an article in the New York Times, I saw a couple of days ago that was pretty ridiculous. It was basically about, the headline was something like, rising rents are causing couples to live together faster than planned. And my first thought was, why don't you just find a friend if you're not ready to move in together? But, I guess that's too old fashioned to do that. But, I do think, though, just being realistic, I think there'll be more roommate situations, but people do need that space to work from home. Even in a flexible work arrangement, you need some space to work from home. And so, one of the things that you're talking about on the development side, I don't think floor plans are changing dramatically, but I think it's accelerated a trend toward more flexible space, where we've seen before, like, rather than, kind of a specialized office, it's more about just having, having room that's conducive to being able to work from anywhere. So that could be in a bedroom where there's now a nook, or we've seen some larger closets people are using where it's like an open closet with like a desk space that you can use for Zoom calls. But also things like outdoor amenities has been a big one, where we've seen developers who, before it was just the pool, and now they're trying to give you a little more outdoor space to kind of be outside, have a good Wi-Fi connection in those areas. So we've seen some minor tweaks of things like that, nothing dramatic. And on the single family side, they're naturally more conducive, of course, to work from home. And so I think that's a trend that's to stay. Particularly now we've seen a lot of the build to rent stuff, dedicated single family rental communities, and using a bedroom as an office. That just gives you some flexible space to use it.
Yeah, makes sense. So I love the amenities. That is excellent. All right, let's talk about Class A versus, and I hear you talking about affordability. Class A, with a recession, a lot of people say, well, I'm going to go into the Bs, and C is a different value add. And, we've got some older assets that are out in the market, and I don't really want to get into that because I'm going to need to, use a bridge loan. And right now, bridge loans are pretty volatile.
Yeah.
What are you seeing moving forward? I think a lot of investors are looking for Bs.
Yep.
How does A, is it positioned attractive? Is it something that we should be looking at? I know I talked to Scott earlier today. We feel strongly about the A's. What do you think investors think about A's? The returns, the yields are a little bit lower, but certainly gives you.
Well, I mean, I'll tell you, I mean, I'll give a few caveats here. Like I when you look at the A space, I think there's reason to be bullish, but I'd be bigger on the A- space than the A+ stuff, particularly if you look at urban. And not because it's urban and the COVID situation, move to the suburbs. I mean, I don't think it's that. I think the challenge is we're seeing so much construction that's still very urban concentrated that lease up competition is going to be has not been an issue so far. But if there is a demand slowdown, it's more of a factor. And I think that when you look at the Class A+ space, the new construction, particularly urban, the rents have gotten so high that you're no longer competing for the Class B renter and the move up flight to quality factor. And so if you're an A- where there's a nice handsome difference in the rents, I think that's a good place. We don't have to do the value add work, it's already done, but you're still not really competing with the Class A+ supply. That's a good thing. If you're suburban Class A and you don't have as much supply competition that's close by, I think that's a good thing. And I think Class B, I like the way you phrased it, because I think oftentimes our investors wrongly will group B and C together. And I think that's a dangerous way to look at it. B is a safe haven in some ways, although it's competitive. B is a safe haven because you're not competing with the new supply. The price differential, like one thing is different. After the GFC, the spreads between A and B rents are too big to really. What happens is, it used to be that you could draw people out of a B into an A through concessions. You can't do that anymore. It'd take a 6-month concession to do that. So B is insulated from supply. And at the same time, you don't have the affordability challenge you see in Class C. The rent income ratios are highest in the most affordable units, which are the Class C. And so you have a little bit of a barrier there, particularly in certain areas. So at the same time, you can't really build a Class B unit. So our sweet spot, I think, is that Class B to A- segment, particularly if you get to that A-, we don't do the value add work for all the reasons you mentioned. I think that's a great place to be. So, long answer, but that's what I'd be betting on, is B+ and A- in particular.
Okay. Do you have a list for our listeners of the top 10 places to be looking? Now, listen, I know that Dallas, San Antonio, all of the 35 is hot, 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 and it's going to continue. We can spend hours talking about that.
Yeah.
Where else should people be looking? Seriously.
Yeah.
Can we get someplace else that rather than Texas, for heaven's sakes?
Of course. So, well, first of all, let's just brag on our team a little bit. Back in 2018, we wrote a paper just making the case that the Sun Belt in general has been grossly undervalued relative to the coastal markets. And obviously we didn't foresee COVID, but what we did notice is that since the downturn, 2008, 2009, we noticed that the fundamentals were much stronger in these Sunbelt markets than in the coastal markets, but cap rates were lower and prices were higher. Capital appreciation was higher in the coastal cities. And so there's this detachment between capital and fundamentals. And so I think COVID has sort of brought a little bit of correction to that. So I guess to answer your question, it's not just Texas, though. It's the Carolinas, it's Nashville, it's parts of Florida, Denver, Salt Lake City. And then as you get smaller, I would, everyone's always looking for the next thing. And I always tell investors is, look, like, don't change strategy too quick. I mean, these macro trends take decades, not months, to change. And so I would still be bullish on the Sun Belt, but as you're looking at smaller markets and better deals, you look at the markets that are near these places. And I would look at places like, I mentioned like Wilmington and Asheville, North Carolina, Greenville, South Carolina, the Sarasotas, the Naples, the Space Coast in Florida, Savannah, Georgia, and going out west, the places I mentioned like the Provos, the Midwest, like a Grand Rapids, all of these are great markets. They're just smaller. But they have similar drivers on a much smaller scale. And so if you could identify, those types of places where you're, going to get a better deal, I think you can be more optimistic still on the fundamentals outlook.
Amazing. So let's talk about Phoenix, Arizona. Everybody, okay, so in 2007, 2008, you couldn't give away your house. There were blocks and blocks of people that had left, empty houses. That's not the case now, but there are things that are going on. We've got possibly shortage, sustainability, really. What do you think about Phoenix long term?
Well,
yeah.
So I'll tell you, first of all, when we wrote that paper in 2018, we did not include Phoenix. We coined a term we called the Fine Nine as kind of an alternative to the so-called Sexy Six, which are the Coastal Six. And we did not include Phoenix in that. Now, in hindsight, you can say we were wrong, because obviously Phoenix has been one of the hottest markets. But Phoenix is also a very volatile market, and it's definitely gotten better and more diversified. But I still am, and we could have a healthy debate on this. A lot of people disagree with me vehemently. I would still put it a notch below the Dallases and the Denvers of the world. Now, that said, it's obviously a strong market, but I think the risks there are also greater. We're already seeing it's kind of pulled back on rent growth a little bit. It's going to be a great market in the long term, but I do think that its downside is probably greater than being in some of those other spots, and it's also gotten really expensive. From an investment standpoint, you see a lot of California money that's moving into Phoenix. And so it's not that I'm negative on Phoenix. I would just be careful about Phoenix. I still think it's more of a volatile market than I don't think we're going to see anything I hope we don't see anything like 2008, 2009, but I don't think we will. But I would just be careful with it. I think it's the best word.
Okay, excellent. All right, and not to get too political, because that's not what I'm here, but we have a big couple things that have happened politically over the last couple weeks that may be driving some people to leave some states. Do you see that is going to affect the rental market, and how?
No, I mean, I think that, the politics goes both ways. I mean, I mentioned I'm here in Texas, and people hear all the time, people moving from California because of the politics there. I think you're going to have people who leave some states to another state. I think that in general, those narratives tend to be on both sides, tend to be louder than reality. And particularly in this kind of work from anywhere world, I think we have more flexibility to be wherever you want. So no, I don't think it's going to have a dramatic impact. Now, I think a bigger factor is on the investment side, where there's heightened focus now on regulating rental operations and investments. And that's something that is really changing the equation a little bit, where, policy risk is now a major factor to consider in places like California and New York, Oregon, Washington, Massachusetts, and even Minnesota. So, NMHC, National Multifamily Housing Council, they did a survey of their members, and it showed that a large number of investors are now basically redlining these markets altogether, which is crazy, because these are historically the most liquid markets investors wanted to be in. So, you can view that from the other side as well and take a contrarian play and say, hey, look, this could be a time to actually get in there. And that could be true. I don't think prices have corrected that much to allow it to happen. But I think policy risk is a much bigger factor than, other current events right now.
So let's talk about that, because I did sell all of my properties in California
Yeah.
because of that, because
Yeah.
of this. And in a time where, I mean, I could have probably made another 400,000 if I would have stayed another couple months
Yeah.
in my properties. But, how does that look? Will we ever see that on a state by state, or would it be by city?
Yeah.
What do you see? What do you think?
I think it's more city by city, and
Okay.
but yeah, it is funny, by the way. It's like I can't tell you how many people I talk to in California who don't own anything in California but have massive portfolios everywhere else. But obviously, there still could be a great place to live. But I think it's more cities than states. I think California is an exception to that rule. California, it's not just, rent controls and everything else. It's really just a very hostile attitude in general toward rental operators. I had a chance to speak to the California Housing Finance Agency a few months ago, and they actually asked me, which I was kind of surprised by, like, hey, like, what's the perception of California housing? And I was like, well, since you're asking, I'm happy to tell you that. And and I mean, there's, in fact, President Obama, I think it was today, yesterday, he was in the news. He was talking about how some of the most liberal places are actually the most hostile to housing development and preventing affordable housing and really NIMBYistic attitudes. And, California really embodies modern day NIMBYism. And that's what's really, and what the part that, I mean, I know you get this, people don't think they get, is that every time you add regulations and costs, like just recently, the court just affirmed in California the requirement that landlords pay a 1 month rent to the renter after an eviction that occurs. Well, that's not funded by the state. And so because landlords make their money from residents, who do you think really pays for that? Well, they keep adding more and more of these things that drive up the cost of renting. And so it's not that it's not a bad idea, but they're all unfunded mandates. I mean, obviously, let's help people. Sure, let's find ways to do that. But you can't just saddle that on businesses who have to pass those costs back to the residents. And so California, I think there's a detachment between, there's an honest desire to help people, but an inability to figure out how to properly fund that. And until they do, I think it's going to remain a challenging environment for investors. And that's why, the Harvard Joint Center for Housing Studies, they put an annual report on rental housing. It's fascinating. It shows that California has a very large share of ultra high income renters and ultra low income renters and a very small middle compared to the rest of the country. And it's not a coincidence, unfortunately. So, I think going forward, like, I mean, I'm kind of going on here a little bit, but I think those risks are expanding other parts of the country, particularly big cities. And if you're a really long-term investor, I think it's a reason to, in general, be optimistic about suburbs where these, political tensions tend to be, or the policy risks tend to be a little bit less heated than they are in the big cities.
Yeah, great. All right, let's talk about other commercial assets. We've got senior housing, took a big dive in COVID. We see student housing still struggling from a debt perspective. We see office struggling. Retail is doing well. Restaurants are doing well. What do you see in those asset classes that are struggling? Where do you see it going? Is it going to continue to struggle? Are you going to see this office to apartment conversion? Is that real? Doesn't seem like it's makes a lot of sense, but what are your thoughts on that?
Well, yeah, on the last one, I think it's a great idea, but I think, as you all know, that the challenge is these buildings are built for offices, not for apartments. So the building plate, the depth is not really conducive to converting in most cases. So we'll continue to see that happen on a very small scale, but it's going to be more the exception than the rule. Unfortunately, it really is unfortunate, but it's not an efficient conversion for the most part. I wish it were, because it's great when you do see it happen, but it's just hard to pull off. Now, office, I by no means am I an office expert, but I mean, just common sense, I think office is a challenging space for the foreseeable future. Retail, as you mentioned, I think in the right spots can still be attractive, although I think it's becoming more of a, it's becoming more strategic in making sure you're in the right, places, the right tenants, because obviously there's more winners and losers in that space. Industrial has done really well. And then you mentioned senior and student. I would still be bullish on that. I think all of the residential categories, there's reason to be bullish on: student living, senior living, the affordable housing space, conventional apartments, single family rentals. I think there's reason to be optimistic. I mean, seniors, it's, obviously for the reasons you mentioned, there's a short-term hiccup, but the demographics are what they are. There's going to be demand there. Again, I think it's just making sure you have the right product that's attractive to your audience. And student housing, student is a space where I think it's really about making sure more than ever that you're close to campus. We've seen we track student housing very closely, and there's been I think particularly as we started to see moderation in the number of college age adults in our country, the 18 to 24 age group. I mean, that was a big reason for the student housing boom in the last 2 decades and all the construction. That big camel hump is going away. Now, the numbers aren't going down, but the growth rate basically flattens. And so it's not just pure kind of numbers games anymore. So I think it makes it more important to just get good locations. But the first rule of real estate, right? Location, location, location. And so I think if you're in good locations and not next to, but walking distance to a campus, you're going to probably be fine, but I probably wouldn't be excited about being 5 miles away with a purpose-built student housing property.
Yeah, got it. Well, and those are still challenges, the student housing. Scott and I did a deal up in Auburn, and it was challenging to get senior housing. They felt it was strong enough to go to conventional, and it's been great. It's a great 3 assets. So, all right. If people don't know about RealPages, can you tell us a little bit about your services, why somebody would use your company?
Well, sure. Just real brief. I'm not a good spokesman for RealPage, but I should be. But RealPage is one of the largest providers of commercial real estate, primarily residential real estate software in the world. We were publicly traded until last year, when then we were sold for one of the largest ever software buyouts at more than $10 billion last year, acquired by Thoma Bravo, and which is a big private equity group, and they've continued to invest in RealPage and kind of driving expansion of our business. And so most of what we do is in software tools like property management, revenue management, BI tools, expense management. Everything owners and operators need to run rental housing, whether it's SFR or multifamily. I'm on the data side. And so one of the things we're able to do is kind of glean all the data that runs across our software through millions and millions of units, and kind of get a real-time pulse in the market. And so it's a lot of fun to be able to see that much data, not just, I'll tell you, as a data nerd, I hate asking around. I think it's the worst metric. Everybody loves it. It's in the news. Underwriters use it. I think it's garbage. And so being able to see actual rent roll data and trade outs and real revenue, it makes me feel like a kid in the candy store, because it's more, real time and real. So that makes my job a lot of fun.
Well, making decisions has to be data driven now. This whole thing, again, COVID created something very different, and data will drive these. We can't necessarily look at historic because it's completely different. So you kind of have to make some assumptions and see what trends are out there. So you're the guys making a lot of the great decisions. I couldn't do it. It's not my area of expertise, but wonderful. Now, if you were to give someone words of wisdom in this market moving forward, what would you say? What would you tell us?
Well, that's a great question. I would really encourage people to play the long game at this point. I think the short term is really tough. But also, y'all are the guys and men and women who are actually making these decisions. So you're doing more than me. I'm just looking at data and giving some, bird's eye view advice. So I'm not as brave as everybody else here, but I'm really bullish on the long game. I think that, if your strategy requires you to be in a disposition, situation in a year or two, there's definitely, I mean, it could be a challenging environment, timing's tough right now. But if you're able to play the long game, you're going to do well. Like the macro factors for rental housing, multifamily and single family rentals are so favorable, and they're not going away. Like these are demographic factors. They're lifestyle factors. Like these things just do not change overnight. Like those things are going to be in the favor of rental housing for the next decade or two at least. And so that's my best advice, is play the long game.
Yeah, I mean, and to that fact, a lot of these people got involved. These people I'm saying investors in general, got involved in right before COVID, right in COVID. They haven't seen the interest rates be up in 7, 8, 10, 13%. So on average, we're at 5.5. I mean, it's pretty consistent. We're right about where we were back in 2017. Not a lot has changed, but it is this frenzy that we've been so used to. And I think it's scary for people who are new to recognize that, hey, it's been a honeymoon for the last 2 years, 3 years.
Yeah.
And it cannot keep that pace. But over the long haul, we're in great times. And multifamily is a great asset over the long haul. I think you're right on with that. So
well, and one last thing on that point, I'll tell you, I tell people this all the time. It's like, I think by the time all of us retire, we're going to look back at 2021, first part of 2022, as the best period ever in our careers in terms of just pure fundamentals, revenue growth, rent growth. That's not going to be normal. There's even people who've been in the industry for 40 years and never seen anything like that. And I don't think we ever will again in any of our careers either. So, but that doesn't mean the future isn't bright. Again, I think there's a lot of reasons to be optimistic.
Great ideas. All right. Anybody in the house? First of all, before we go there, Jay, how do we get I don't want to open up your contact information.
No, that's fine. Yeah.
Are you sure? So how would we get a hold of you?
Yeah, I'm active on LinkedIn, as some of you know, so you can find me there. Just search for Jay Parsons or RealPage. And I post on Twitter as well. But we also have a blog, realpage.com/analytics, and there's a profile there. You can find my contact information. But it's I'm always enjoy trading notes on these social media channels and bantering on these topics, and definitely would welcome any feedback too, where you're seeing things that I'm not seeing.
I do like that about you. You don't just post something and disappear. You really are active and respond and get the conversation going. I
can't help myself.
I love it. That's a good quality that you have. Anybody in the house have a question? 2, 3 questions? Candace, you always have questions. Do you have anything today?
Well, Julie, you really did a fine job. Everything that I wanted to a couple of things I wanted to touch on, it was fantastic. But the one thing I do want to try to get out as quickly as possible, because Mutual Omaha's Wild Kingdom is going on outside and my dog was barking. You touched on, I read in a newsletter that I found to be kind of interesting, and you touched on the different asset classes of C, B, and A, and they were saying that Class A was not to, here he goes. The Class A was there is a distinction between the B and the C, and particularly the B and the A. And I just wanted to comment that was really great to hear, because in the newsletter, they were saying that there's less of a demand for the B and the A. And I was kind of puzzled by that, because it seemed like it was a whole sector of high tech companies are increasing the demand. And that seems like that would be the sector that would be possibly needed more.
Yeah, no, you're right. And I think there's demand. What's crazy right now is there's an undersupply of housing at all price points, A, B, and C, and in pretty much all markets. So, I think there's a kind of this conventional wisdom, as things get more and more expensive, everyone's going to flock to cheaper stuff. But in the grand scheme of things, rentals are still pretty cheap. John Burns Real Estate Consulting did an analysis recently showing the difference between what it would take in terms of mortgage and cost and the cost of home ownership monthly versus renting, and it's still a big discount to rent for most people unless you're putting down a huge down payment. So it's still fairly cheap in the grand scheme of things, and Class B rents are not terribly expensive in most places, so, and even A in a lot of places. So yeah, I think there's a lot of demand in all these price points, again, barring a big downturn that hopefully we don't see.
Yeah, great. Good question. Anybody else? Scott Dilly, you got a question?
Yeah, I have a question, Julie.
Okay, I want to hear from you, Jason.
Hi, Julie. So, Julie, we were having this conversation via email, and I've been debating this since I've been to the Multi-Family Investors Nation conference last week, which is how am I going to be aggressive but still not put my investors at risk when it comes to financing for the next 6, 12, 18 months. Should I even still look at bridge financing, or should I just go really conservative and just go agency debt? What is a smart thing to do for the next?
Yeah, Jay, do you want to tackle that one on, being aggressive in these times, being conservative? What do you see in terms of debt?
Yeah, well, I mean, I think it just depends on your debt partners, right? I mean, debt's getting more expensive. And so, if you're able to, I'm definitely no financing expert, but I think the biggest challenge a lot of deal makers are finding is that they can get the equity to cover the loan to value differences that the lenders now want. And so if you can still marry those things together and have the right debt partners, then again, I'm a big believer in the macro story, but I think that's more about what who and what people like Julie, you who just making these deals work. But if you get them done, I think you're going to, in general, I think you should be in good shape.
Yeah, good. Cap rate expansion. What is your thought on that? We'd love to hear your, over the next couple of years. What's your take?
Yeah, no, I think, first of all, I think the relationship between cap rates and interest rates tend to be overstated. I don't think it's not a direct correlation, but obviously as interest rates get higher, we're probably going to see some cap rate expansion, but I don't think it'll be that dramatic. And the reason is that apartments in particular are still very attractive relative to other investment types. And so as investors sitting on cash right now, as everybody knows, is losing money. Mm-hmm. And so if you have to put your money somewhere, apartments still look really attractive relative to other options. So, and because there's still a pretty good yield on an apartment deal relative to other things, I don't think it's going to push the cap rate up that much. So I think we'll see some cap rate expansion, but I don't think it'll be as dramatic as we've seen in just basic interest and kind of the core interest rate.
Okay, that's good to know. Do you get involved at all with the reversion cap rates at all? Do you ever comment on that?
No, the reversion cap rate, I'm not
sure.
Yeah,
so the takeout, when you go to sell it, do you add 10 points?
Oh.
Do you add 25? I think that's also going to be affected. I didn't know if you had any thoughts on that.
No, it's I don't have any particular thought on how to, I defer to the experts on how to best structure these things. But again, I just think there's a lot of investors right now sort of waiting things out. Yeah. But at the end of the day, I think we're going to see a lot of money still come back to the sector.
Yeah, I agree.